There is a financial maneuver sitting quietly inside the benefits portal of thousands of publicly traded companies right now. Most employees scroll past it during onboarding, distracted by health insurance tiers and dental plan comparisons. They click through it like a terms and conditions checkbox: present, acknowledged, ignored. And that indifference, year after year, costs ordinary workers tens of thousands of dollars in guaranteed money they simply never claimed. This is not a hot stock tip. This is not speculation. This is not some influencer selling you a course about passive income through affiliate links. This is a federally regulated benefit baked directly into the compensation structure of companies like Apple, Microsoft, Salesforce, and thousands of others, and it has been quietly minting wealth for the employees shrewd enough to actually use it. We are talking about the Employee Stock Purchase Plan, the ESPP. And once you understand how the math works, you will likely feel a very specific type of frustration, not grief, not regret, just the clean, sharp irritation of realizing you left money on the table. A publicly traded company offers an ESPP as a way to turn its own workforce into shareholders. The logic from the company's perspective is straightforward. Employees who own stock tend to care more. They watch earnings calls with different eyes. They feel the rise and fall of a share price in a way that transforms abstract corporate goals into something personal. The mechanics work like this. You elect to have a portion of your salary withheld across a defined period, typically 6 months, sometimes 24 months, depending on the plan structure. That money accumulates. At the end of the period, the company uses your pooled deductions to purchase shares of company stock on your behalf, almost always at a 15% discount to the market price. That discount is the engine of everything that follows. Most plans carry what is called a look-back provision. This is where it gets genuinely extraordinary. A look-back provision means the discount does not just apply to the price on the day of purchase. It applies to whichever price is lower, either the price at the beginning of the offering period or the price at the end. The stock went up during the 6 months. You buy at 15% below the starting price. The stock went down. You buy at 15% below the current, already reduced price. Heads you win. Tails you win slightly less, but you still win. This is not a metaphor. This is the literal, contractual structure of millions of ESPP agreements active right now across the United States, the United Kingdom, Canada, and beyond. Here is where the conflict begins. Because this is where human psychology collides hard with financial logic. When employees enroll in an ESPP, many of them treat it like a long-term investment vehicle. They accumulate shares. They watch them. They get attached. They tell themselves they will sell when the time is right, which often means they tell themselves they will sell when the stock is higher, which often means they never quite sell at all, because the stock is never quite high enough, and then one day the stock is lower than when they bought it, and the 15% discount has been entirely swallowed by market movement. The mathematically correct behavior in most circumstances is immediate sale. If you can sell the shares the moment they are deposited in your account, and many plans allow exactly this, then you have just converted a payroll deduction into a 15% return on your money. Depending on your contribution level, the numbers become striking very quickly. Say your salary is $80,000 per year. Most ESPPs cap contributions at 10% of salary. That is $8,000 per year going into contributions, $4,000 in each 6-month period. At 15% below market, you are buying $4,000 worth of contributions in stock that has a market value of roughly $4,706 the moment it is purchased. Sell immediately. Walk away with approximately $700 in profit on that 6-month cycle. Do it twice in a year. $1,400 in near-guaranteed profit on top of your salary in exchange for filling out a form. Now run that same math for someone earning $150,000. $15,000 per year in contributions, split across 2 periods. Each period yields a gain north of $1,300. Annualized, over $2,600 in pure, near-risk-free profit. Captured, annualized, reinvested over 10 years that compounds into something meaningful. And here is the conflict that makes this interesting. The company is, in a sense, betting that you will not sell immediately. The whole philosophical architecture of the ESP is designed to create long-term shareholders, to align employee incentives with corporate performance. The 15% discount is a hook meant to keep you invested, emotionally and financially. The look-back provision is bait. The instant flip is you eating the bait and swimming off with the hook still in the packet. You are doing exactly what the rules allow. The IRS has codified it, the SEC has regulated it, your broker will execute it without hesitation. But you are subverting the intended spirit of the instrument. And some employees, particularly those with a deep loyalty to their employer, feel vaguely uneasy about this. That unease is not legally meaningful. It is just psychology. Acknowledge it, then ignore it. There is a complication here, and it is worth confronting directly rather than burying in small print. ESPP gains are not all taxed the same way, and the distinction matters enormously depending on how long you hold the shares before selling. The IRS separates ESPP sales into two categories: qualifying dispositions and disqualifying dispositions. A qualifying disposition requires you to hold the shares for more than 2 years from the start of the offering period and more than 1 year from the purchase date. A disqualifying disposition is everything else, including, critically, the immediate flip strategy described above. When you sell immediately, you trigger a disqualifying disposition. The 15% discount, that guaranteed profit, is classified as ordinary income, not a capital gain. That means it gets taxed at your marginal income tax rate, not the lower long-term capital gains rate. Depending on your tax bracket, this can meaningfully reduce your take-home profit. This sounds alarming, but let us be precise. If you are in the 22% federal tax bracket and you capture a $706 gain, you owe roughly $155 in additional federal income tax on that gain. Your net is still over $550 per period. The math still works. The return is still extraordinary compared to virtually any equivalent risk financial instrument. A 15% gross return reduced by income tax still beats a high-yield savings account, most bond funds, and certainly beats the zero you earn by never enrolling at all. The tax argument against the immediate flip is often deployed as a reason not to enroll or not to sell. It should not be. It is simply a reason to factor your actual marginal rate into your net profit calculation before congratulating yourself on the gross figure. The phrase near risk-free appears frequently in financial discussions of ESPPs, and it is accurate, but it requires a specific definition of near. The risk in an immediate flip ESPP strategy is narrow but real. Your payroll deductions are held for the duration of the offering period, 6 months in most cases. During those 6 months, your money is not in a savings account earning interest. It is not invested in anything. It is sitting, waiting, accumulating. If you needed that liquidity in month 4 of the offering period, you would need to withdraw from the plan, which most plans allow, but which typically means forfeiting that period's discount and receiving your contributions back in cash, uninvested. There's also the window risk. From the moment shares are deposited in your account to the moment you execute a sale, you are exposed to market movement. If you are selling within minutes or hours of purchase, this exposure is trivially small. If something delays your sale, a trading halt, a brokerage outage, a personal circumstance, the window widens and the price risk grows. In 2022, employees of certain tech companies discovered this the hard way when share prices fell sharply in the hours and days following ESPP purchase dates. None of this disqualifies the strategy. It contextualizes it. The risk profile of an immediate flip ESPP is dramatically lower than buying individual stocks, dramatically lower than options, and on par with or below most fixed income instruments, while offering a return that none of those instruments can match. There is a ceiling to all of this, and the IRS imposes it directly. Under Section 423 of the Internal Revenue Code, an employee cannot purchase more than $25,000 worth of company stock, measured at the fair market value at the start of the offering period, through a tax-advantaged ESPP in any given calendar year. This means that the maximum gross purchase value of shares you can receive through a qualifying ESPP plan is $25,000 per year. At a 15% discount, you are contributing approximately $21,250 to acquire stock worth $25,000 yielding a gross gain of roughly $3,750 annually before tax for someone hitting the ceiling. That is the top of the range. Many employees contribute less, sometimes far less, either due to salary limits, cash flow constraints, or simple unawareness of how aggressively the plan can be used. The practical takeaway is this: if you have the capacity to contribute the maximum and you are not doing so, you are declining a legally structured, employer-funded bonus and giving it back unclaimed. This is perhaps the most interesting dimension of the whole story. ESPPs are not a secret. They appear in every benefits summary. Human resources teams describe them during onboarding. Financial advisors who work with corporate employees know them intimately. And yet, participation rates across the industry hover somewhere between 20 and 30% of eligible employees at most companies. The reasons are partly practical. Cash flow constraints make it difficult for lower-income employees to divert even 5 or 10% of their salary into contributions. But the larger reason is psychological. The ESPP is presented as an investment vehicle, which triggers in most people a fear of market exposure and a reluctance to engage with something that feels complicated. The framing buries the discount. It buries the look back. It buries the immediate flip option. It presents the plan as something for people who believe in the company long-term, which sounds noble and feels safe, and quietly excludes the people who simply want to capture a guaranteed return and move on. The financial services industry has a long history of benefiting from complexity, from instruments that are theoretically available to everyone but practically navigated only by those with the time, education, and professional access to understand the details. The ESPP is unusual because the detail that matters most, the 15% discount, the look-back, the immediate sale option, is not technically complex at all. It is just buried under language that makes it feel like it should be complex. If your company is publicly traded, open your benefits portal today. Search for ESPP, Employee Stock Purchase Plan, or Share Purchase Scheme if you are in the United Kingdom. Read the offering document. Look for 3 things: the discount rate, the look-back provision, and the immediate sale eligibility window. If all 3 are present, enroll at the maximum contribution rate you can afford without financial strain. Set a calendar reminder for the purchase date. Sell immediately, report the income correctly at tax time, repeat every 6 months until the plan ends or you leave the company. That is the entire strategy. No spreadsheet required. No market forecast needed. No thesis about the company's future growth. Just a form, a payroll deduction, and the discipline to sell before sentiment convinces you to hold. The 15% is already there. The only question is whether you will go and collect it. If this video helped you understand something your benefits portal never bothered to explain clearly, subscribe, because there are several more of these sitting inside your compensation package, and most of them look just as boring and matter just as much.